Many people get into stock investment dreaming of the one day that they can just live off their stock dividend income from their stock portfolio. That is why many people love to invest in high dividend yield stocks. Sometimes these high dividend yield stocks can reach a 10% dividend yield. Such high returns sounds extremely attractive, right? But is it really a high return or just a trap that sounds too good to be true? Join us in the rest of the video to find out more. Hi, welcome back to Mr. Money TV, your favorite financial edutainment network. Here we are, all about learning finance in a fun way. So if you like that, click the subscribe button and turn on the notification to follow us for the latest video. Also, do follow us on Facebook and Instagram for the latest activities and updates. So what can be so potentially dangerous for a high dividend yield stock? Let us start with a simple story. British American Tobacco Berhad, a big blue chip company that was once listed on KLSE. The stock declared an impressive dividend yield of around 5.6% based on its share price in the year 2015. Many investors were impressed by the dividend yield, and in today, 2020, BAT has an even higher dividend yield of more than 9%. Truly, it's a dream come true for dividend stock investor, right? And you must be thinking, what can go wrong since they can give such a high dividend yield? Maybe you would like to join the bandwagon and invest in this high dividend yield company. Surely, 9% dividend yield sounds fantastic, right? But if you did, you have just stepped into what we call a dividend trap. Here's why. If you own 1,000 units of BAT in 2015 at the price of 55 ringgit per share, that would be 55,000 in value. Today, in the year 2020, your shares will only be worth 10,000 ringgit. That's more than 80% drop in value. If you're not disappointed enough, you may still argue that you still got yearly dividend. Maybe that would cover, right? Well, let's look closer into the dividend. While the dividend yield is impressive, let's review the value of each dividend payout from 2015 to 2019. In 2015, BAT declared a dividend worth 3 ringgit and 12 cents per share, and for 2016, 2 ringgit and 78 cents per share. Then, in 2017, 1 ringgit and 69 cents per share. In 2018, 1 ringgit and 55 cents. Then finally, in 2019, only 1 ringgit and 18 cents. As we can see, while the dividend yield was increasing year by year, the real value of the dividend payout to shareholders was significantly reducing. So, if you own 1,000 shares in 2015, that year you would have received a dividend worth 3,120 ringgit. But in 2019, you would have only received 1,180 ringgit. That's about a 60% drop in income. Imagine if you are depending on this dividend income for your living expenses. I feel for you, man. Not to forget that you have also lost 80% of your capital, as we pointed out earlier. How can this happen? Firstly, you have to understand, what does dividend yield means? The calculation for dividend yield is the dividend declared for the year divided by the latest share price. The calculation for dividend yield reveals much about the problem itself. So technically, when a share price drops, the dividend yield will get higher and higher, looking like a fantastic investment for gullible investors. So bear in mind that dividend yield shouldn't be your final yardstick to decide if you should invest in a company or not. You have to look into why the dividend yield is high. Is it because of a declining share price or the value of the dividend is increasing? Since we have shown you what a dividend trap looks like, let's now take a look at what a considerably healthier dividend share would look like. Let's say one that all of us are familiar with, Maybank Berhad. If you own 1,000 shares of Maybank in 2015, you would receive a dividend of 54 cents per share that year, which means you will get 540 ringgit in dividend for that year. then in 2019, you would be receiving 64 cents per share, which is 640 ringgit in dividend for that year. This means an increase of 18% in dividend income for you. As we can see, a healthy dividend-paying company usually would increase its value of dividend distribution over time. This is surely one of the signs that you must look out for when investing in dividend stock. Another good example would be Time.com, a broadband company that is listed on Bursa Malaysia. To simply put it, if you own 1,000 shares in 2015 at 7 ringgit per share, you would have a total value of 7,000 worth of shares at hand. And in that year, 2015, you would receive a dividend of 67 ringgit. Fast forward to the year of 2019, with the same amount of 1,000 shares, you would have received 290 ringgit in dividends for the year 2019. And today, in October 2020, your shares would be worth 12,000 ringgit. That's a whooping 71% increase in capital and 332% increase in dividend. To put it in short, while dividend yield could look like an attractive number to assess a company, depending on dividend yield alone to make investment decision will be extremely dangerous, and it might lead you to fall into what we call a dividend trap. So always remember that dividend comes from the cash of a company, and the cash comes from earning of a company. A company has to be performing well over the years to pay out healthy dividend to its shareholder. If you are thinking about dividend investing strategy, you have to look for more than just dividend yield. Take into account the company's performance, their earning, and their future prospects to make a sound decision for your investment. Thank you for watching this video, and in our next video, we will be sharing with you more tips on how to pick good dividend stocks for your portfolio. And if you have any stories that you fell into a dividend trap, we look forward to see your comments. See you next time. That sounds too good to be true. Join us in the rest of the video. Narration 讲好了，我也再来讲出来。So, what can be based on its share price at that in the year of 2015 up to today in 2000 不好意思 worth of 3,120 ringgit 3,120 ringgit or 3,100